our podcast, Keeping It Real. Welcome back to Keeping It Real. Today, we're talking about a topic that comes up constantly in planning conversations: real estate investing versus leverage investing.
And right out of the gate, let's be clear. This episode is not an anti-real estate. Okay, real estate can absolutely be a legitimate wealth building strategy.
Yeah, exactly. The issue isn't whether real estate works, it's whether people are seeing the entire picture before committing. Philip, when clients bring this up, what's usually driving the interest?
The biggest thing is cash flow. People love the idea that renters are paying the mortgage and there's money left over every month.
Right, it feels passive.
And right behind that is the belief that equity is immediate, that once you buy the property, wealth just starts showing up.
Yeah, there's also a comfort factor, right? Real estate is tangible. You can see it, touch it, drive past it, and that's what makes it feel safer. So let's talk reality. Philip, start with equity because this one trips people up.
Yeah, equity is not immediate. Property value takes time to grow, and appreciation depends on market conditions, interest rates, and location.
Yeah, and markets don't move in straight lines. Like you can own a property for years without meaningful appreciation.
And good tenants don't magically appear. You may interview several people, verify income, run credit checks, and things still go sideways.
Which introduces non-payment risk and vacancy risk, right? Expenses don't stop just because rent does.
Then, of course, there's the upkeep, maintenance, appliances, roofs, plumbing. These costs are real and often underestimated.
Yeah, and rental income is taxable, which can significantly impact your net returns.
Yeah, right. Either you manage the property yourself, which costs time and stress, or you hire a manager that reduces cash flow.
Yep. And real estate is what we call illiquid. You can't sell a portion of a property if you need fast cash.
Plus concentration risk, one property, one location, one local economy.
Yeah. And then when you add rising interest rates, refinancing risk, and the emotional stress, that's when people start asking another question.
Right. Before we talk about alternatives, Irene, let's pause and let's actually take a look at growth side by side. Okay, I'm just going to share my screen if that's okay with you.
So what you're seeing on screen is a comparison starting in 2016, right? The top chart shows the average residential home price in Ontario. And then the bottom chart shows the growth of a $10,000 investment over the same time period.
And this isn't about saying one is better or worse. Okay, just understand that, people. It's about understanding how growth behaves and what you experience along the way.
Yeah, real estate often appears smoother because we're looking at averages. What doesn't show up here, though, are the interest rate changes, the carrying costs, the tenant risk, the maintenance, or even the liquidity constraints.
Yeah, exactly. The volatility didn't disappear. It showed up in cash flow, pressure, refinancing risk, and stress instead of daily price movement.
Yeah. With investment-based strategies, volatility is visible. You actually see the ups and downs, but you also see diversification, the liquidity, and the flexibility.
And this chart starts with 10 grand. Not a down payment, not leverage, not debt, just time, consistency, and structure compounding through market cycles.
Yes, and to be clear, this is a historical illustration, not a prediction of future results. So this brings us to an alternative many people actually overlook called leverage investing. Philip, who is this actually for?
If you can afford rental property or qualify for a mortgage, you often already have the capacity to leverage invest. Leveraging investing means just borrowed money at a low interest rate to invest in diversified growth assets instead of tying capital to physical property.
Yeah, same long-term growth goal, but just a different structure.
Now, with the concept of zero overhead, no repairs, no property tax, no tenant issues.
Yeah, zero upkeep, no maintenance schedules.
Diversification, liquidity, scalability.
Yeah, and often a similar, sometimes it's faster, growth timeline without any kind of operational stress.
Plus estate planning efficiency.
So leverage investing isn't risk-free. Borrowing requires discipline and proper structure.
Exactly. This is about suitability, not hype.
Yeah, and the question isn't really about whether real estate is good or bad.
It's which strategy fits your life, your cash flow, and more importantly, your long-term plan.
And that's keeping it real.